Welcome to This Explainer. If you spend any time studying Warren Buffett or rigorous valuation frameworks, you know the old saying, price is what you pay, but value is what you get. But how exactly do we calculate that value? Today, we're diving into a comparative analysis of 9 major blue-chip stocks to see how different analytical lenses reveal completely distinct market opportunities. If you've ever wondered why Mr. Market prices one stock as a screaming buy and another as a value trap, well, you're in the right place. We're going to break down exactly how different models, from classic discounted cash flows to forward earnings multiples, paint entirely different pictures of risk and reward.
So the first thing we have to remember is that value isn't some monolithic concept. It's a great reminder that the optimal choice depends entirely on your risk tolerance and your investment horizon. A model that highlights a deep value discount, giving us that classic margin of safety, might actually terrify a momentum investor. On the flip side, a growth model prioritizing massive AI tailwinds might look wildly overvalued to a traditional bargain hunter like us. Different valuation models give us uniquely tailored angles, and truly understanding those angles is absolutely crucial to navigating the market safely.
Here's our macro landscape. We're looking at 9 absolute heavyweight companies spanning healthcare, financials, energy, industrials, and tech. Each one of these presents a unique profile based on consensus price targets and financial catalysts. We have varying degrees of analyst upside here, from modest single-digit gains to massive potential jumps of over 50%. But, just looking at the raw upside is never enough. We have to dig into the fundamentals and categorize these opportunities based on the underlying reason for that upside.
Let's quickly run through our agenda. We're breaking this down into 4 distinct investment profiles: undervalued bargains, the AI growth engine, high-stakes turnarounds, and finally, quality at a reasonable price.
Starting with Section 1, Undervalued Bargains. We are searching for deep discounts.
Okay, let's look closely at Pfizer. The absolute crucial point here is this massive 59% undervaluation metric. So where does that number actually come from? It's derived from a classic discounted cash flow, or a DCF model. It essentially measures the mountain of cash the company is projected to pump out by 2030, which in this case is roughly $16.4 billion in free cash flow. That model yields an intrinsic value of $64.92 per share, which is way higher than where it's currently trading. But, and this is a massive but, you have to weigh this incredible margin of safety against their looming $17 billion patent cliff spanning from 2026 to 2030. It's the ultimate battle between current cash generation and future revenue risks. Are you willing to hold through the turbulation for that long-term payoff?
This brilliantly illustrates how value appears differently across sectors. Look at these 2 totally different value metrics. Charles Schwab looks incredibly cheap relative to its growth, sporting a PEG ratio of just 0.34. That means you're basically paying pennies for future growth. With $7.2 billion in core net new assets recently reported, that ratio suggests the market is vastly underpricing Schwab's future earnings power. Meanwhile, over in the energy sector, ConocoPhillips trades at an enterprise value to EBITDA multiple of just 6.7 times. Compare that to the broader energy sector average of 12 times, and you're looking at a huge discount, especially for a company with a super predictable 56-year dividend streak. Like I said, deep value takes many forms.
Moving to Section 2, the AI growth engine. This is where you're paying a premium for momentum. Now, if you're a value purist, you might want to cover your eyes for this one. Analog Devices benefits heavily from accelerating AI demand in data centers, but its current price-to-earnings ratio is sitting at a sky-high 76 times. Contrast that with its historical median of just 26 times. This tells us a very clear, cautionary story. Mr. Market is pricing in absolute perfection. Sure, analysts are universally bullish right now, but at 76 times earnings, your margin of safety is practically zero. The stock might currently be overvalued with absolutely no room for any disappointment in execution.
Amphenol presents a similar momentum story, but with its own unique flavor. Yes, they recorded massive Q1 orders of $9.4 billion, completely driven by AI data center demand. And they have a fantastic book-to-bill ratio of 1.24, meaning for every dollar of product they ship, they're getting $1.24 in new orders. They literally can't fulfill orders fast enough. But they're carrying $18.7 billion in debt. This highlights a classic trade-off. You have massive market tailwinds pushing revenue, but you have to accept serious balance sheet risk and the execution risk of integrating their recent CommScope acquisition. A heavy debt load is always a major red flag when we evaluate long-term financial strength.
On to Section 3, high-stakes turnarounds. These are your classic high-risk, high-reward situations.
Boeing is pretty much the poster child for this category right now. Their valuation metrics are heavily skewed. They're sitting at a PE of roughly 95 times and a massive debt-to-equity ratio of 7.4. This is a company near break-even, far from the wonderful, predictable business it used to be. But the turnaround catalyst is immense, a potential 500 aircraft China deal. If that goes through, it could radically reverse their fortunes. However, to actually get there, Boeing has to navigate severe, persistent production issues, not to mention the ongoing political hurdles and skepticism surrounding the brand. It's a binary make-or-break bet on management's ability to execute.
We also see Pfizer fitting perfectly into this turnaround narrative. Remember how we just looked at them as a deep value play based on cash flow? Well, aside from its cheap valuation, successfully executing on its oncology and obesity pipeline is the primary catalyst here. To offset that $17 billion patent cliff we talked about, they can't just rest on their laurels. They need to turn their pipeline into market-ready, revenue-generating products. So it's really a dual-lens stock. It's deep value on paper, but a high-stakes turnaround in practice.
And finally, Section 4, quality at a reasonable price. Finding premium franchises at fair value.
This is the sweet spot for a lot of long-term investors. When evaluating these quality metrics, we see companies trading at moderate discounts or at least very fair multiples relative to their own historical averages. Take American Express, a classic Buffett favorite. It has a forward PE of about 19, which is sitting right near its historical median, despite consistently beating EPS estimates. Then you have Intuitive Surgical. It has a high absolute PE of 55, but that's actually below its 5-year average, and analysts see the recent 20% year-to-date drop as a prime buying opportunity. These metrics give you a solid balance. You're buying strong, durable franchises, but you aren't overpaying for them.
Uber perfectly captures this quality category. The growth numbers here are fantastic, with a 44% year-over-year jump in non-GAAP EPS and revenue growing at 14%. More importantly, management is showing a truly owner-oriented capital allocation strategy with a $3 billion buyback program alongside key investments in autonomous driving. And yet, it's trading at a reasonable 22 times forward earnings. You get high growth without paying that extreme momentum premium. Obviously, it's not without risk. Macroeconomic conditions and regulatory threats are always there, but the underlying business engine is firing on all cylinders at a totally fair price.
So that leaves us with the question to reflect on for your own strategy today. We've seen how the exact same market can offer a massive 59% discount in a legacy pharma company, demand a 76 times premium for an AI chipmaker, or offer a balanced 22 times forward multiple on a tech giant doing massive buybacks. Based on these frameworks, which lens makes the most sense for your risk tolerance and time horizon? Keep these models in mind the next time you're evaluating intrinsic value. Thanks for joining me for this explainer. I'll leave you with this. In a market where a 95x PER turnaround play and a 7x EV/EBITDA cash cow exist on the exact same day, are you pricing your portfolio for the world as it is today or the world as it will be tomorrow?